Okay, welcome to another video, and in this video what we're going to do is we're going to take you through the Global Cross-Asset Market Monitor. Now this is a report that's part of my institutional service, and the point of this video is just to show you this, just to help give you a little bit more insight into what I'm actually doing here at Topdown Charts. And I'm going to basically make this video into two halves. So the first half is going to be basically just looking at what is this report and you know what the actual thing is, explaining what it is, why I do it. And then the second half is going to be basically just a bit of insight. You know, what is it actually telling us this week? And so I'll put the time that the second part starts in the description of this video, so if you just wanted to skip straight to that, then you can go ahead and do that. But as for what this report is, so I currently have 3 reports. I'm about to launch 2 new reports as well as part of my core institutional service. And so there's the monthly chart book, brings together all the key insights, all key charts, asset allocation guide, capital market assumptions. The weekly macro themes, that's the flagship product, so that's 5 different ideas each week. And then the markets monitor is a way of basically just getting visibility on what's going on globally, and you know, to be honest, it's also part of my workflow. You know, as I do this, I pick up on various things to go and have a bit of a further look at. And the way that I delivered it is basically there's the PDF which you're looking at now. So that is a set of standard charts, and that, I mean, I just go through and update all the data in that every week. And you know, I'll pretty much, it's an exercise of hitting refresh, but I'll, you know, obviously eyeball the data and check the charts, make sure that everything is looking the way it should be, make sure there's no data errors, which can happen from time to time. Or, you know, sometimes I have to reset the axis on the chart because it's some markets either made a new low or a new high. But that's basically it. And then there's an email over here. So this email here, basically the bit of observations. So again, we'll go through this in detail in a second. So there's some observations, basically 7 sort of highlights from the charts, and then a chart of the week. It started off as a single chart of the week, but then I sort of ended up adding to it, and you know, these days it's usually 3 or 4 charts, so it's more of a market theme of the week, if you would. And then down at the bottom it also has what was in the latest weekly macro themes report, so you can see there what was in there last week. So I'll just move back to the top here. We'll come back to this in the second half of this video where I'll talk through each of these things. But if we go back to the PDF, so what I'll do, well firstly go through what it is. So again, it's basically a snapshot of what's going on in the markets to provide a bit of visibility. And so it covers all these different asset classes and markets here. Try to cover sort of, you know, close to everything. Not, you know, obviously not everything. You can't really cover everything in you know, one little PDF. It's 16 pages, but try to cover most things. So I'll show you here. The first page is the global market breadth monitor, and so these are basically showing you 200-day moving average breadth across equities, government bonds, US dollar, commodities, emerging market currencies. Pretty much it's designed to be, you look at this web page and you can instantly see what's going on in markets. You know, if obviously if it's a bit of a risk off situation like it is at the moment, then government bond breadth is going to be rallying, ticking up. US dollar breadth tends to tick up, risk off. Current currencies kind of rolled over there, same thing with commodities. And then you go into the major equity benchmarks, and if they have an implied volatility index, I've put it on there as well. For example, for the VIX there. And that blue line there is the 200-day moving average. So we've got Euro stocks, Nikkei 225, FTSE, Canada, Australia. Oh, good. I managed to put that bar away. I didn't know how to do that. So it's good that that's out of the road now. US page here, so small caps, NASDAQ, the Dow, in case anyone still watches that. The transports, small caps versus large caps, value versus growth, cyclicals, defensives, S&P 500 versus MSCI ACWI ex-US, which is global equities excluding US. Discretionaries and staple, consumer discretionary staples, S&P 500 against emerging markets, and then through to the rest of the sort of the major DMs, so Germany, France, Switzerland, New Zealand, because I have New Zealand clients. Emerging markets then, and so the MSCI EM, Hong Kong, India, Brazil, South Africa, Korea, Taiwan, Thailand, blah 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 blah, all the rest of them you can see. And then these ones are global equity sectors. So for example, this one, it's energy sector of the MSCI All Countries World Index, so that's what the ACWI stands for. So it's in tracking those in local currency terms, and so that's energy performance relative to the ACWI. If that line was going up, that would mean that energy is doing well, as you can see, and as probably most people know by now, energy has not been doing well at all. It's just been a one-way street for energy, really. And similar story in materials. And then you got just all the other main GICS or GICS sectors there, so industrials, discretionary, staples, healthcare, tech, no surprise there. Financials, utilities, telecoms, though that one has actually changed its name, I should update that. And then into sort of, which I guess you'd call this page the liquid alternatives. So you've got REITs here, which is the main global REIT index there, US REITs, A REITs, Australian, J REITs, Japan, global listed infrastructure index there, MLP index there, Eureka Hedge monthly hedge fund index there, tracking what the hedge funds are doing performance wise. And in lieu of actual private equity numbers, which are kind of hard to get, got listed private equity there, which is quite an interesting one to track up, really. And then of course into treasuries, key market here, so we've got the various different maturities there, so 30-year yield, 10-year yield, 5-year, 2-year, 3-month, and then the curve, so 10s minus 2s. Then tips, so the break-even component of that, or the sort of, I guess you can call that the market-based measure of inflation expectations, and the real yield component on the right-hand side there, which is basically if you take the here we go, the 10-year nominal yield, you can basically break that down into inflation expectations and real yield, and that's what they look like. Then into credit, so IG credit, investment grade, high yield credit, or junk bonds as they are sometimes called. So 5-year CDS here, so the median 5-year CDS for US banks, and European banks. This was a popular area to worry about in recent years, but not much going on there at the moment. Corporate CDS there, so this is median across the various US industry sectors there, and as you can see, across all of them, US credit risk pricing had actually come in very significantly. Of course, junk bond spreads have shot back up along with VIX and equity risk, which tends to trade pretty closely with. Sip of my coffee. And then a couple of sort of popular credit risk or liquidity kind of measures there. So LIBOR, OIS spread, TED spread there. Interestingly enough, despite all the panic at the moment about the virus or concerns, there's these two have actually come down quite a bit, which I thought was quite interesting. Europe high yield credit there, high yield credit spreads, sovereign risk pricing in the Eurozone. Obviously there was a time almost a decade ago now that was something that was watched very closely. Emerging market corporate credit spreads, EM median sovereign CDS, so this is the median sovereign credit default swap spread or premium rather for across all the various countries in emerging markets. It's interesting to see how low that one's come. Then 10-year government bond yields for emerging markets, kind of split these into two charts, the sort of lower yielding ones and the higher yielding ones on the right there. 10-year government bond yields in developed economies, so the majors there, and then also Australia and New Zealand. I have a lot of clients in Australia and New Zealand, so obviously I have a bit of it, and obviously being located in that region, I tend to cover this stuff quite a bit. And then again, inflation swaps, so that's kind of similar to the market-based measure of inflation expectations, or similar to the break-evens. And then real yields, basically taking the nominal yield and take off inflation swap, and that gives you the real yield, which again, those have rolled over. Well, inflation swaps are rolled over along with commodities and real yields. So inflation swaps are very sensitive to what's going on with commodities, but also growth and actual inflation. Real yields quite sensitive to both growth expectations and risk sentiment. So obviously, with both of those things getting a bit of a hit recently, those have rolled over a bit. Currencies, so we've got US dollar index up the top there. EMFX, so this is my own index here that I've made it out of 25 different emerging markets currencies, equal weighted, so that they have, every country has an equal vote, rather than, a lot of the times you get these indexes being just effectively just being one country and a few hangers on. So this gives you a good idea of what's going on in general for emerging markets. And then the same concept here for Asian FX. In both respects, it's against US dollar. And perhaps unsurprisingly, both rolled over. USD CNY, that one's opened back up again. It was closed for the last week. It's obviously gone up a bit in this sense because it's got the USD CNY. If it goes up, that means CNY is getting weaker, as you should probably know. Then you've got the majors here: Euro USD, Cable, USD Yen, Swiss franc, and then a couple of interesting closely followed crosses. So Euro Yen, Aussie Yen. Aussie Yen's quite a good one to track because it tends to be quite macro sensitive. That's why I've got it here. So obviously the Aussie dollar is quite sensitive to commodities and China, of course. Meanwhile, the yen tends to be one of those currencies that rallies in a risk-off environment. So when you see this, when you see Aussie yen rallying, that gives you a good view of macro sentiments turning up in that kind of situation. Then you've got pound yen, euro pound, and then a couple of other ones. So Aussie USD, Kiwi. Obviously these two are ones that I watch very closely as well, keep a lot of models on, get a lot of questions on. And a few other ones there, a couple of EM ones there and the reason why I've included these ones is because because you kind of already get the information from these kind of emerging market currencies in the EMFX index, but these ones you call them commodity currencies, and speaking of which, it kind of gives a good prelude into commodities. So we've got the GSCI, it's kind of one of the major commodity benchmarks there, and then the sort of sub indexes from that. So GSCI industrial metals. Actually noted this one, I'll get to it in the email in a second, but it has actually broken down through support there. But one thing, sort of get dragged into it here, but one thing I would note is that copper hasn't broken down yet, still at support there. Similar as zinc hasn't broken down yet. And same thing with aluminum, or aluminium, depending how you like to call it. Hasn't broken down either. But anyway, back to the describing of this. GCI agriculture, so that's all, that would be soft commodities, grains, etc. So soybeans, all the rest of it. Livestock, obviously that's cattle and hogs. And then just got the kind of like the major ones there, so WTI crude oil, gold, copper, silver, um, and then a few other ones that are kind of good to keep an eye on as well. So natural gas, gasoline, again aluminum, zinc, iron ore, obviously that one's close to the heart down in this corner of the world. CRB, raw industrials, it's always an interesting one to keep a track of, even though it is a rather odd index. Contains all sorts of weird things like burlap and tallow and all the rest of it. Wheat, soybeans, coffee. Obviously coffee is one that a lot of us are very interested in. And then I have got a little bit of definitions and notes there, but I've also managed to sneak some volatility charts in at the back. So we've got gold implied volatility. Because if you remember back a few pages back, we had the equity market volatility. So we've got gold volatility there, crude oil, FX. So this is my own implied volatility indexes here. They're made of equal weight, I believe, for developed markets and emerging markets. And then 10-year treasury volatility down the bottom right there too. So it's always it's one of those things that's good to just have a bit of visibility about. It may not be it may not be super interesting week to week, but every now and then something will happen on one of these charts that makes you pay attention. Like actually just a couple of weeks ago when treasury volatility hit the lows, I remarked actually about that in this markets monitor report. I think it was a week ago, a couple of weeks ago, probably a couple of weeks ago actually, and alongside the fact that treasuries were putting in all these oversold signals, and so that was actually just at the start of the rally in treasuries. It's always good to pat yourself on the back because when you get these victories, you've got to take them. So that's the PDF, and now it's be a good idea to just go into the email. So again, as I mentioned before, you got the observations, so the highlights. We've kind of already gone through them, but I'll just quickly run through them there. So global market breadth, you've got equities, commodities, EMFX down, risk pricing, USD government bonds up. Basically your classic risk off, deflation, macro pessimism dominating kind of situation. Equities, Nikkei, Eurostox, FTSE 100, Russell 2K, so small caps, Dow Transports, and MSCI EM. All of those actually rolled over from, I would say reasonably significant overhead resistance lines. And so, the comment that I put here is that the virus is the catalyst, but, when you're brushing up against a major resistance point, any excuse can trigger a sell-off at that point. It's quite a vulnerable point at that point. And by the same token, those resistance lines are good to be mindful of, because obviously if they broke out, then it would be a different story. Number 3 there, US small caps making new lows against large caps, and same thing for value versus growth. These are two of those things that we're probably going to do good this year, because if you did get this global synchronized upturn, which I think there's still fairly good case to be made for that. Maybe it gets delayed a little bit, but those have gone on to new lows. Treasuries testing the lows. Yep, we kind of already looked at that. The point that I did add there was that the other major developed market 10-year yields are still relatively not at their lows, so they haven't quite gotten down to that point yet, which is kind of interesting. I guess it's people are disproportionately expressing their bearish views by buying US Treasuries. It's the largest, most liquid market. And then real yields, as I mentioned, rolled over, broken down through support actually. And because real yields trade inversely to gold, that kind of puts what's happening in gold, or the new highs in gold, into context as well. Currencies, US dollar actually briefly retested the 200 DMA, 200-day moving average. So it did drop below, but then it kind of had an attempt to get back above, but actually closed the week below there. So, I've got a pretty, well, I think pretty compelling bearish case for the US dollar this year. And I look at the chart and it's pretty much looking that way so far. I mean, you don't want to run your victory lap too early in the game, but it looks like the US dollar is actually rolling over. However, Asian and EMFX, they've also actually rolled over in the short term and are likely to retest the lows. And obviously USD CNY has been, or CNY has been weakening as it's opened back up today. Commodities, yeah, basically already covered that as well. So industrial metals broke down through support, but copper, zinc, aluminum, they haven't broken down yet, still at support. And I'll kind of expand on that in a minute because it kind of touches on that in the chart or theme of the week. And similarly, crude oil and the headline commodity index are also both at support. So chart of the week this week is actually 3 charts of the week. Kind of the first one though is this macro fundamental gauge. So if you follow me on Twitter, you'll be maybe familiar with this. So I asked these weekly surveys, and part of that is, well, there's 2 of them, bonds and equities, and there's 4 options. You're either bullish, bearish for fundamental or technical reasons. And so what I've taken is the fundamental spread between, well, the spread between the fundamental bull and bears for equities, and the spread between the fundamental bear and bulls for bonds. So it's kind of flipped because, economic logic is that basically in a good macro environment, equities tend to do well and bonds do not. So basically just aligning the signal the way that it should be. And so it gives you this macro fundamental gauge that's rolled over. You can see that there was this initial optimism, and so I've actually put this here. I'll quickly read through these actually. So the title is Macro Optimism Evaporation. The macro fundamental sentiment indicator from my weekly Twitter surveys has collapsed back to August 19 levels after some initial optimism. Price action aligns with this. Global market breadth indicator has pulled back sharply from previously strong levels that I highlighted a few weeks ago. And the copper gold gold ratio and UST 10-year yield have both dropped back to early September levels, close to 2016 levels too actually, which I'll get to in a second. So clearly there's been a major shift in sentiment that has taken place. My read is that this is basically the market more so in macro land, less so in the S&P 500, that basically the market is pricing in worst case scenario for the virus impact. My view is that to break further lower in yields, in commodities, etc., you're going to require a bit more than just a bit of panic selling and speculation on what is really a fundamentally uncertain risk. Nobody really actually knows what the outcome's going to be, whether it's going to be benign or less than benign, despite the scary headlines. So we've got that, which I just talked about there, and then the market breadth indicator. So this is a combined market breadth indicator. It's pulled back from previously very strong levels. So much like the previous one, it combines the market breadth indicators that we saw on the first page, so equities, EMFX, commodities, and inversely risk pricing, government bonds and US dollar. You can see that's pulling down. Going to be watching to see whether that little trend line can hold or not. So that's going to be quite a useful little macro sentiment trigger there. And then on a similar note, so the copper gold ratio, as I noted, has dropped back to the August-September lows and is trading near the 2016 lows. So this is quite a significant move really. And likewise, 10-year yield is closing in on the lows, closed at 1.505 last week against the September low of 1.429. Clearly both are at a key juncture. I mean, this is a key support level here. Um, you know, very major support levels. So again, as I noted, to break further low is going to require, you know, a bit more than just speculation, and especially given that we've seen actually a bit of a better data pulse of late, and you know, I'm still seeing very strong signals from the leading indicators. So I think this is the floor. So that's basically it.